Good afternoon, everyone. Pat Ganley here with Angus Geddes. Angus, how are you today?
I'm good, Pat. I will say your line is a little bit crackly.
Is it okay now?
It's better, yeah, a little bit better.
Okay, cool. Okay, thank you. And let's welcome all the members today to the webinar that Angus and I will be doing. There's quite a bit of things that we want to get through today. So again, Patrick Ganley and Angus Geddes will be doing the presentation today. Some housekeeping items first. Please note that
Pat, sorry to interrupt.
Yes.
It is sort of fading in and out. It's not. It doesn't seem like it's a strong connection. Anyway, I'm just letting you know that.
Okay, I'm trying to fix it now, but it seems to be okay.
You just keep going, and we'll just do the best we can.
Okay. Again, just some general housekeeping items. All the information today is provided on a general advice basis. So before acting on any of the information in this presentation, please consult your financial advisor before doing so. Past performance is no indication of future performance. If you have any comments and questions, you'll have the opportunity to ask the questions during the presentation. As you can see with the orange arrow, you can enter them into the screen and we'll endeavor to answer all the questions that we can. If you cannot hear the presenter or Angus or I, please call the office on 1-300-8811-77, and we'll look to help you out with that. And at this point in time, we'll get on with the market update. Angus, it's been a pretty interesting week in the markets. I thought we'd start with this chart. The SPX takes out key support, correcting the lower levels. So maybe you could just talk us through this slide, please.
Yeah, look, I think you know, the markets have been quite choppy. You know, there's been a fair amount going on. You know, we've had the obviously the outbreak of geopolitical tensions in the Middle East, and that's quite significant. You know, the Hamas attacks on Israel, which have occurred 50 years and 1 day after the Yom Kippur War was launched by Syria and Egypt. I was astounded to learn that the other day. 50 years and 1 day to the day. So look, you know, we've got rising geopolitical tensions. You know, it didn't help with Putin attending a military nuclear drill that was on Bloomberg this morning. So that's in one side of the market's corner. Then we've had a very tumultuous bond market. You know, those US Treasury yields have been quite volatile. Big jump in the yield curve last night. They're still in the process of trying to find a ceiling. I think that you know, we are looking, the US bond market is looking like it is approaching a ceiling in terms of a yield cap, but you know, that remains to be seen. But that has also been a pressure point for the stock market, particularly those expensive technology companies. And then of course we're now in the middle of earnings season, and you know, about a third of the S&P 500 companies are reporting this week. We've already had you know, a number of high-profile names such as Amazon, Microsoft, Alphabet have all reported. We've got Apple later this week. Meta Platforms reported after the bell, and it's been a mixed bag. You know, for every you know, company that you know, has come out with a resounding beat and upbeat guidance, you know, we've had a company that's come out that's been down on, you know, where earnings are going. And I think there is near-term risk to the market, not so much in terms of the actual results. You know, with Wall Street doing its typical thing where, you know, 80% of the companies beat guidance. Guidance is, you know, sort of lowered into reporting season. I don't mean that, but I'm really talking about future guidance and where earnings are likely to go over the coming 2 quarters, and you know, the December quarter and the March quarter. And I think we're going to get quite a few downward revisions. So that's making the US indices look expensive. We've seen downward pressure in the S&P 500 this month, and also in the NASDAQ 100, where a lot of those expensive growth and technology stocks have been particularly vulnerable. We've seen defensive growth and value outperform. The energy sector, for one, has done a better job. If we just put that S&P 500 chart back up, if you can just go back up chart. Yeah, I just want to talk about the technical setup, and the technical setup has deteriorated. So what we've seen this week is the primary uptrend that the S&P 500 established from those October lows and November lows last year, that's been broken on the downside. We've also seen the index take out that 200-day moving average and go below that big 4,200 support level. So I think this sell-off in US stocks has got a bit further to go. I think this correction has got at least another 4 to 8 weeks on the downside. And I know a lot of investors are looking for the typical Christmas rally. I don't think we get one this year because of those downward earnings revisions and geopolitical risks, etc. So I think, technically we're looking like the S&P 500 is looking like it could continue to ratchet down to, a target of sort of 4,000, 4,050. And I don't think we're going to see anything like the October lows last year. But, in terms of where the index is at the moment, it could be another, between another and 7 to 10% on the downside. I don't think it'll be much more than that. And then if we look at the next slide, the NASDAQ.
Yeah, I just wanted to ask you a question about this, Angus. I mean, you've been talking a lot about the bond yields. We've seen reporting season kick in here. We've had some mixed results with some of the big tech companies announcing the results. I know you touched on earnings there, but there's been quite a bit of pressure on the NASDAQ at this point in time. Do you continue to see that happening?
Look, I do, and let's not forget that the Magnificent Seven, those big mega cap tech stocks, and indeed a lot of the semiconductor stocks and technology companies and chip manufacturers, they really led the rally this year. It was quite narrow in terms of what was driving the market higher. If you look at the equal weighted S&P 500, it's actually down on the year. So, valuations for these types of stocks do look stretched, and a lot has been baked in terms of what has to be delivered in terms of earnings growth, to maintain valuations for some of the expensive sectors of the market. So I think there's more downside risk in the NASDAQ 100. We saw that index break below that sort of key support at around that 14.5, 14.6 level this week. And I think, there's further risk to the downside. A bit like the S&P 500, we could easily see another 7 to 10% downside. I think 13,200 is going to be a big support for the index. I don't see it going much beyond that in terms of the corrective sell-off. But by the same token, Pat, I don't see the NASDAQ 100 going back down and testing those October lows at 10,800. So I think that the downside will be mitigated. And if we stand back and look at it, the markets had this big run. Markets are never linear. And I think what we're going to see is a decent 50% retracement of that December 22 to July 23 peak. That big run, I think half of those gains will be retraced, and that's something for us to keep an eye on, as we move in towards the end of the year and indeed 24.
Okay, so we'll move on to the next slide here, which we'll have a talk about, which is US bond yields. Still trying to find a ceiling. How do you see the US bond yields moving at the moment?
Look, I think my view is that we're seeing the US bond market put in a major medium-term top. for the US 10-year. I'm sort of sticking to my view that around that 5% level is going to become the ceiling over the medium term. And we can see on this big quarterly chart, which goes right back to the early 1990s. The US 10 years, obviously the yields had this huge move, this big breakout move this year, and I think there's going to be a lot of support for the bond market around that 5%. Every day, I'm watching Bloomberg, I'm listening to the tape, I'm reading the financial news. There's just so much. There is a lot of demand. A lot of people are just going to go. A lot of investors are going to say, well, 5%. That's a pretty good, risk-free rate of return. And I'm a buyer at these levels. So I think, sticking to that view that the bond market will start to settle down, but that is yet to be proven. Last night's move, 14, 15 basis points on the top side, it was pretty violent. But there we go. We might be seeing peak fear around, sort of medium, near-term fiscal funding, fiscal spending.
Do you think this sets up the Fed increasing rates higher?
I do. I think there's
who's going to be the big loser if that's the case? Who's the big loser in these higher?
Let me answer the first part of your question. I think the long end of the yield curve has done a lot of the financial tightening for the Federal Reserve. They've alluded to that. Jerome Powell's mentioned that. I think they've been surprised at the move higher in bond yields, and there's no question that has tightened financial conditions around the world. This is coinciding with, I think, major bottoms in emerging markets such as China and Hong Kong. We're seeing those stock markets really bottom out, which are impacted by capital flows and certainly by the strong dollar that is sucking in these high bond yields, are really sucking in capital flows from around the world into the US. So yeah, financial conditions in the US and around the world have tightened considerably, and I think the top is close to being in. Now, in terms of your second part of your question, who's the biggest loser? Well, a lot of people would probably say, well, I've my bond portfolio, which is 40% bonds or 60% bonds, has had a shocking year this year. We're the biggest losers, but I think you'd have to say it's the US government, because that $33 trillion US debt is going to require a lot of debt servicing. Gone are the days where the 10-year was trading down at 0.5%. It's now 10 times that. So all things being equal, the cost of servicing that US national debt by the government has gone up, and it's going to require a lot more bond issuance to fund those interest costs. And as a lot of that US debt rolls off and expires and gets replaced with coupons at much higher yields, that's just going to exacerbate the government spending in terms of the debt servicing costs. So, I think, looking out over the medium to longer term, I don't think, unless the US government really gets its fiscal spending under control, I would have to stick to my core view, and that is that the US bond market is in a secular bear cycle, which is going to go for a number of years. And whilst we might have seen a medium-term top and these 10-year yields at around that 5% level, we could easily see 4% if the Fed starts cutting next year, and the economy looks like it's going to have a hard landing. We could easily see 4%. I think looking out over the longer term, yields are headed higher. So the biggest loser is the US government, because they're paying more in debt servicing costs on that, on that rapidly growing national debt.
And I must say, you've been making this point for quite some time now, so it's very consistent, and I think that's a key theme that you've stuck straight to that story. So if we get to the US, if we get to the dollar reasserting to the top side, these are a couple things I want to talk to you about with the US dollar, how that you see that playing out? And, you know, if it's going to continue to go up, how do you think that impacts the gold price? But let's just focus on this chart at the moment, the dollar reasserting to the top side.
Well, you know, the US dollar is looking better than what it has looked in recent weeks. We can see how this chart's actually a couple of days old, but the dollar index has actually broken above downtrend resistance, you know, over in the last couple of months. So that sort of says to me that the greenback's probably going to be headed higher. We have seen that as a result of higher bond yields, capital flows, you know, the United States having that favorable interest rate differential advantage over the rest of the world, which is enticing capital flows into the States. So, you know, that's a tailwind near term for the greenback. And of course, we've also seen some safe haven buying, you know, with, you know, the situation in the Middle East has probably fueled some safe haven buying. So yeah, look, near term, the US dollar probably is going to go a bit higher. But as we were talking about, you know, to the previous slide of the bond market and talking about, you know, who the biggest loser is. I mean, at the end of the day, if the US debt servicing cost is going to go through the roof, it's going to mean more bond issuance. It's going to mean a poorer credit rating. And ultimately, you know, that's going to be bad news for the greenback. So, you know, I'm a medium to longer term bear on the US dollar. I don't think the greenback's going to get anywhere near the highs the dollar index made last year, up around that 114 level. I don't see that happening. And in fact, you know, I think it's going to struggle really to get much beyond, you know, 107, 108. So yeah, probably worth mentioning that near term it is reasserting to the top side.
And how do you tie that into the gold price? I mean, obviously the US dollar going up isn't really great for the gold price, but we've got all the tensions in the Middle East, which seems to be supporting the gold price at this point in time. What are your views on gold right now?
Yeah, look, there definitely is a geopolitical premium that's crept into the gold price. You'd expect, you know, given the strength that we've seen in the dollar, that both oil and gold would be under pressure. You know, that historical relationship that correlation has almost sort of broken down. You know, with the outbreak of what's happened in Israel. You know, and I suppose the world's waiting to see where that conflict goes. Does it become regional? Does it become a contained conflict? You know, there's a number of just unknowns, and you know, as long as we've got that sort of happening in the background, I think, you know, this geopolitical premium is set to remain in precious metals, and it's actually, you know, holding its own in US dollars. And as I've sort of mentioned in previous webinars, and you know, I wrote a lot about this last week actually, we're seeing record levels in local currencies around the world. You know, it doesn't matter whether it's the pound, euro, Japanese yen, the Chinese renminbi, the Australian dollar. You know, we've seen record levels in local currency terms. So, you know, of course, you know, this is great for the local domestic gold producers and local currency. You know, they're making great profits and cash flows at the moment in local currency terms. But it's interesting that, you know, gold's now also rising in US dollars. And if we look at this chart, this is just a 1 year daily chart. The technical setup, you know, we've got gold breaking the downtrend that was in place since May after it hit record highs. It's corrected down to 1800. It's bounced off that. It's broken the downtrend. It's now pushing up against overhead resistance to that 1980, 2000 mark. So, you know, an upside break through that level would see another renewed test at the record highs, which is around that 50, 20, 75 level. And, you know, given that we've got a US dollar that's running on the still running on the upside, it's not going to be that causes it. If there is a topside breakout, in coming weeks and months, I would say that, you know, the reason for that would be, and the catalyst for that would be a deterioration in geopolitics, regional geopolitics around the world, unfortunately, Patrick.
And what other commodities are you looking at? I know we've spoken a little bit about silver. Is silver still something you got your eye on at the moment?
It is indeed. You know, it's not like gold testing their record highs, historic record highs, but it's not far off its 10-year highs. But more work to do. You know, I think energy's been good, particularly those large cap energy stocks. It looks to me, you know, there's a number of reasons that energy prices are going to hold up. You know, around that sort of 85, 90, $95 level, and then, you know, that's been a good defensive place to be. I think those energy major energy companies in Australia and around the world are generating really good cash flow. It's also, we also quite like the uranium space. You know, that's reasserted to the top side. I think we've got a chart of that. And the next slide.
Next slide's the ASX 200 looking to
Yeah,
correct lower.
if
one of the things I wanted to touch on
just,
with you was, yeah, go ahead. You want me to go to the uranium?
I was just going to say, let's just finish, we'll round out about the commodities. You know, oil has been running. I think uranium also is looking really interesting. You know, this has been running to the top side, and uranium spot prices or contract prices have been holding up as well, despite, you know, the fact that we've had quite a strong US dollar. And, you know, it's encouraging to see URA, which is the uranium ETF, the Global X uranium ETF, which is listed in the States, also listed in Australia under the code of ATOM. That's reasserting to the top side, so that's quite encouraging. So I think we're going to continue to get some relative outperformance there. And elsewhere in the commodity space, if we just have the next slide, this is the Spider Energy ETF. I thought it was worth highlighting this chart this week because, you know, we've had this nice, consistent primary uptrend since 2020. A big break above historical resistance at 68, a number of tests which have held against that primary uptrend. And here we are today, you know, we're looking at multiple tests of that historic 7-year high at around that $92 level. So I think it's only a matter of time really before this, you know, before this energy ETF breaks out on the top side. So by definition, that means that, you know, what I'm saying, Pat, is I think we're going to see higher oil prices. You know, that's my view, whether it's demand supply related, whether it's geopolitical, whether it's OPEC, you know, reducing the taps. I think, you know, a catalyst is coming that's going to be behind that breakout. And if we go back to uranium, what's driving that is this growing recognition globally that the world is just going to have to backstop renewables and green energy with nuclear. I think it's as simple as that. And, you know, we've had, you know, uranium spot prices coming out of this huge bear market, this multi-decade, well, this one, it was over a decade of consolidation, and it's running to the top side. So I think those are sectors that, you know, I think can do really well in the year ahead.
So with the energy prices, and we're talking about oil, you know, that's not helping the inflation story at the moment, is it? And we're hearing a lot of rhetoric at the moment that inflation's going to be pretty sticky here, and we're potentially looking at interest rates here in Australia going back up again.
Well, you know, yeah, if we talk about Australia, you know, the CPI print this week's been disappointing. I mean, if anything, it's really looking like the RBA's got no choice now but to go again on the top side with another 25 basis point hike. I think that's coming. And they've tried to hold the line. They know how precarious, the housing market is in terms of mortgage owners and borrowers hanging on. And unfortunately, it's looking increasingly like the RBA have got no choice, because our inflation is higher than many other countries. But we're way higher than the US, and it's looking like they're going to have to go one more time, and it could be the straw that breaks the camel's back in terms of the economy. So, in the last couple of months, we've really seen the ASX 200 pull back from those sort of near record highs at 7.6 to trade 6.9 on the ASX 200 this week, trade below 6.9. And we've seen that primary sort of uptrend broken from the 2020 pandemic lows. So what this says to me is that the market's probably in for a greater pullback. And this is in line with, the scenario playbook that the US indices are now in correction mode. We're going to see some further downside in those US indices. My view is that there's another 7 to 10% on the downside to go for those major US benchmarks. Could be a bit more than that, might be a bit less, but that's the sort of range that I'm looking for. And I think, with respect to the ASX 200, the RBA does, if they do put another rate hike in, we are exposed. We could see another, 200 to 300 points of downside in the local market. I don't think we're going back to 6,400, which is where we've sort of bottomed out last year. I don't think we'll break those lows, simply because the commodities and the resources are providing a big support for our market. And I think, it's that engine that is going to keep us away from those lows, because I think, as the Aussie dollar comes down, we're seeing spot prices and local currencies for many of those commodities, really push up, and that's really, generating quite a big, or providing quite a big cushion for that sector. So, as long as those commodities hold in there, I think we've probably, in this correct sell-off, we've probably only got another 200 or 300 points to go. And if we sort of round that back to what we've sort of been counselling and advising members, for the better part of the last 6 to 12 months, and that is, nothing wrong with having some cash in the portfolio to really take advantage of those opportunities when they emerge. And I think, I think that there could be a shakeout. I think we're in the middle of a shakeout, which has got at least another 4 to 8 weeks to go. And I'll be looking for the markets to sort of, potentially reach the end of that correction sometime early next year. So I think there's going to be some really good opportunities coming. And of course, I think the Fed's done, Pat. I think they're done on the rate hike front. I think the RBA have got one more in them. And then, of course, as we move into next year, the US economy, I think, is going to slow down quite markedly. And then, of course, focus will then turn to when the central banks start cutting in the next cycle. So it's always good news when we exit a big correction phase and move into a new bull market.
So I just wanted to talk to you a little bit about the ASX 200. And as you said, you think that there could be some support in here with commodities. Do you see China getting more serious about shoring up the domestic economy? And is there a stimulus coming? Obviously, that might be pretty good for the Australian economy.
That's a very good, it's a great question. And I do think they're getting more serious, much more serious about it. And, you'll recall, Pat, that in the last 6 months, since the reopening, the stock market over in Hong Kong and China have been absolutely pummeled back towards their October lows. And there's been this frustration that the Chinese government's not doing enough. Well, this week, not only did they come out with 165 billion US dollar equivalent stimulus package, which is, it's a pretty big package. When they fired the bazooka back in 2008 during the GFC, it was about 550. So 165 is pretty big. Additionally, the government have said that they're going to tolerate a higher debt to GDP ratio. At the moment, they're at about 3% in terms of, you know, debt to equity. Sorry, they're not 3%. They're at about 30%. So they've got scope to take on a lot more debt, given that the debt levels are way below. So I think they are going to get serious about that. The other thing that we saw, which was quite interesting, is President Xi made a visit to the central bank for the first time in his history as, you know, as president of China. And so that's, you know, obviously that's purely symbolic, but it sends a signal that the Chinese government have heard the message loud and clear about getting the economy back on track. I think the property bubble has now unwound. It's been unwinding over there for the last 2 years. I think that has been really quite serious, and a free-floating democratic society, that bubble would have had cataclysmic results. So what the Chinese government have done is they've let the air out slowly. They're going to have to provide a lot more stimulus, and, you know, fortunately for commodities and fortunately for Australia, that means that they're going to have to keep building infrastructure and keeping the economy moving, and which is what I think they'll do. And that's exactly why we haven't seen the iron ore price collapse below 100 a ton like many of the investment banks were forecasting a month or so ago. We haven't seen that. We haven't seen a lot of base metals collapse. You know, they've retreated. Copper's come back, but they haven't collapsed, all holding up. And I think, you know, it's also a reason why we're seeing the energy complex also hang in there and hold together. So yeah, for Australia, I think the commodities are going to continue to be a bright spot, even if we do see growth slow down in the United States, because the Chinese government, they're going to have to keep their pedal to the metal and keep their spending going.
And as we just focus a little bit on Australia here, how do you see this Australian dollar? I mean, it seems to be in decline. Did you think the Aussie's going lower here?
Well, you know, every current currency has been coming off against the greenback. It's not just an Aussie dollar story. You know, it's the euro at 105. It's the pound. It's the Japanese yen, you know, which got to 150 this week against the dollar. So look, you know, I think we're approaching a low. Like, if I did put a chart of the Aussie in the daily a couple of weeks ago, you know, we're at this big sort of bearish bottom, which is typically defined the lower end of the Australian dollar. And we don't actually have a chart in this deck today. But yeah, look, I do think we're getting close. I think the currency has weakened in the last couple of weeks to reflect a heightened risk of recession. You know, we've talked about the RBA putting in one more hike, and that could be the straw that breaks the camel's back, and does trigger a recession in Australia. But we're probably getting close to a you know, a major bottom, I think, for the Australian dollar. Time will tell.
And Japan, I know you're still focused on the financials in Japan. Are you still looking at that at the moment?
Look, I still very much like the financial services. I like the banks in Japan, you know, simply because, you know, they've been deprived of earning a rate of return on their mortgage books for the past few decades, as, you know, the Bank of Japan have suppressed interest rates, much more than anywhere else in the world. You know, they've had a decade of that, and then you know, that followed on from 2 decades of you know, of deflation. And I think, you know, Japan stands out, and the Japanese financials stand out because they're actually benefiting from a rising US bond yields, unlike the rest of the world. In Japan, it's a very different story. and it's expanding net interest margins for the banks. They had compressed valuations amongst the cheapest in the world, and they're still quite cheap, 0.7, 0.8 times price to book. They're not expensive by any means. So I think that is one sector that can outperform. I thought it was really interesting this week, and I wrote about this in today's note, that a major British hedge fund had taken a massive long position in the yen, Japanese yen, betting that the Bank of Japan is going to normalize and relax interest rates next year, which will bring about a huge rally in the yen. I think there's a lot of merit to that view and a lot of merit to that argument. Given that the Japanese yen and Japan's capital markets have been a funding choice for many investors for much of the past few decades. So it could unravel, but I do think that, given the precedent of Japan, they'll just do it very, very slowly. And I don't think it'll be an overnight move by any means, because, that's not how the Bank of Japan have behaved. But I do think there is merit for the Japanese yen to appreciate, and that may well coincide with an important top in the US dollar and a decline in the greenback. But I think that's going to be a story for next year.
And the Australian banks, is that something you think's a story for next year as well? I mean, we know the banks haven't really done that much here in Australia, but is that a next year story, do you think?
I think it will be. I think it will be. We've seen the Japanese banks have been in ranges, big trading ranges for over a decade now, since 2008. And net interest margins have been under pressure because higher interest rates in Australia have seen the banks have to pay more for the deposits. Net interest margins have come under pressure. Mortgage loan demand has gone down, given there's been less investment going on in the residential housing sector. So the banks have been under pressure, but I think that whole narrative changes next year when the RBA moves from a tightening bias to a neutral bias and then to a cutting bias. And whilst inflation is not dead yet, I think inflation is going to come down next year. That's my view. I think it's going to come down, maybe not back to target. And sometime later next year, the central banks could well be cutting. It would be that point that we would see those bank stocks really begin to outperform and go into a new phase. So those are all things to watch out for the Aussie banks. One near-term risk factor of these geopolitical risks, what happens if there's a regional conflict, the Suez Canal gets disrupted, oil goes to 100, 110, that's a near-term risk. And that could have an upward impact on inflation. But I think generally speaking, we will see it sort of come off more and move back towards target next year.
Okay, well, that seems to wrap up all the questions, and I think we've covered everything. Angus, is there anything you're really looking at next week that might stick out, still earnings season, or anything that you're focused on for next week that might impact the markets?
Yeah, look, we've got the PCE inflation gauge. That's the Fed's preferred measure for measuring inflation. That comes out on Thursday morning US time. So that's going to be key. Of course, the market's been wanting to see a favorable print, one that comes in as expected or lower than expected. And I think that will provide impetus for the bond market, which will set the tone for equity markets. So that's going to be something I'll be watching out for. The reporting season, a third of the companies will have reported by Friday. So I'm obviously very, very focused on watching those earnings results. And just going back to what I said, and what we were talking about at the beginning of the webinar, it hasn't been the fact that the companies have been missing guidance. 80% of the companies are meeting guidance and having earnings beats. I'm not placing weight on that. I'm placing more weight on what these companies are saying about the next 2 quarters. And I think there is downside risk in those US indices, simply because, there's a lot of expectation that's been baked in. Unlike the rest of the world, the US stock market did so much better this year. I think only Japan beat the US benchmarks this year. So I'm looking out for those downward earnings revisions coming through, over the next two quarters. So that's what I'll be looking at for next week.
Okay, thank you. Angus, it was good talking to you today. Thank you to all the members that joined us, and we look forward to talking to you in the next couple of weeks. Again, if anybody has any questions or wants to follow up on anything in the webinar, please give us a call, 1-300-88-1177, and we'll sign off for now, and thank you very much.
Thanks, Pat, and look forward to joining you next time on the webinar. And also, Pat, I think next week we will be doing a podcast and doing a little bit of a workshop about the bond market for those members that are interested in just talking about the linkages that the bond market has through to the stock market, and why bond yields are important, how that actually can impact financial markets. And it'll be a bit of a 101, but for those that don't know much about the bond market, it'll be quite interesting. And on that note, I'll say bye for now.
Okay, thank you, and goodbye, and we look forward to that presentation next week. Thank you.